As your financial advisors, we see our job as not only to help you achieve your long-term financial goals, but to achieve them in the most tax-efficient way possible. That's right, we're not your CPA or tax advisor, but a good financial advisor with a tax-efficient approach can be just as useful, if not more, in helping you save your hard-working dollars from Uncle Sam come tax time. Throughout the calendar year, there are several actions and precautions we take that can help you save money on your taxes. Today, we are here to talk about a strategy that we used last month in many of your portfolios. It's called tax loss harvesting. As you know, the goal of investing is to buy low and sell high. But when you make several investments in a diversified portfolio, there are always going to be investments in which you will have losses. What if I told you there is a way in which these losses can be turned into valuable asset to achieve your long-term financial goal? Making lemonade with lemons, that is what this strategy is about. The strategy is very simple. You sell the investments that have incurred a loss and use this realized loss. The realized loss can then be used for many different purposes. Let's discuss this. This loss can be used to offset taxable gains you've incurred in other investments during the year. Up to $3,000 of the loss amount can be used to reduce your taxable income when you file your taxes. That is any taxable income, not just investment related. Any loss not used during the year can be carried forward into future years to use against capital gains or ordinary income. You never lose this loss carry forward during your tax lifetime. So let's say you have a big gain 3 years from now. You can use this loss to reduce your tax bill from that big gain. Let's say Tom has a portfolio of 10 investments. During the year, Tom sold 4 investments for a realized gain, that is, gain from sale of investments of $10,000. If Tom has a capital gains rate of 20%, his tax bill for this sale of $10,000 is going to be $2,000. Now let's assume Tom has an investment in his portfolio that currently has an unrealized loss of $3,000. That is loss from an investment he hasn't sold yet. If Tom were to sell this investment to harvest this loss before the year end, his net capital gain for the year will be reduced to $7,000. 10,000 minus 3,000 equal to 7,000. And his new tax bill will be $1,400. By using this simple strategy, Tom will be saving $600 in taxes. Let's see another example. Let's say Heather had a portfolio of 5 investments. During the year, Heather does not have any realized capital gains from the sale of any investments. But Heather has a position in the portfolio that has an unrealized loss of $5,000. If Heather was to use this strategy and harvest this loss of $5,000, she can use the first $3,000 of the loss to reduce her taxable income for the year and save the remaining $2,000 worth of loss for future to use against capital gains or taxable income in later years. There are some rules about this that you need to be cautious of. First, you can only do this in a taxable account. A qualified account like an IRA account or Roth account or 401k account, there is no capital gains tax, as those grow tax-free. Therefore, you cannot take a loss in a qualified account to offset your other capital gains or income. Second, there is a concept called wash sale that you need to be aware of. Simply put, the rule is that if you sell an investment at a loss for tax harvesting purposes, you cannot buy that investment or an investment deemed similar for the next 30 days from the date of the sale of investments. We will talk more about this in a minute. Third, all tax loss harvesting must be done on or before December 31st of the year. For those of you in Canada, that date is a bit earlier. So let's talk about wash sale rule in detail, as this is really important. As mentioned before, the IRS dictates that in order for this sale to qualify for tax loss harvesting purposes, you must not buy the same or substantially similar investment back within 30 days. Best efforts should be made to avoid the chance of IRS making the sale as substantially similar. This rule of wash sale makes the portfolio management side of the strategy important. You as an investor or manager of investments need to make the important forecast of whether your losing position has the potential to recover its losses within the next 30 days. Sometimes making the sale purely for tax loss harvesting purposes can be a costly mistake if the investment recovers back its losses and you miss out on that recovery. So choosing the right candidate for this strategy is critical. At Parks Capital, we execute this strategy for our clients every year wherever appropriate. We hope this video will help you better understand the reasoning behind those actions. If you have any questions regarding this or any other financial topic, please don't hesitate to contact us.